Ben Breitholtz is joining as data scientist at Arbor Data Science. So, Ben, let's talk some data. Good to have you here. What to you is going to determine if we can get more days like today? What's the top of your list of charts to watch right now for potential growth and reflation?
Yes, I think it comes down to two key factors, one being the job market and how healthy that is. And there's indications that that is still very much a broken scenario with recruiting now falling back relative to the pace of job seekers. But on the flip side, there's also the consumer. How well is the consumer behaving in this environment? And we saw them peak in their activity in early to mid-June, but we're seeing somewhat of a rebound over the past 1 to 2 weeks, which I think is helping fuel a little bit of this rotation, a little bit of this kind of bullish euphoria that we're getting here right now. So it's really how do those fight and battle with each other? You have this long-term perspective of the job market, not healthy, but you have this ultra short-term focus on the consumer, and they're doing okay for the most part right now, maybe not a month from now, but right now.
And then this is pretty interesting because it sounds like what you want to make sure you're doing is separating short-term analysis in terms of like the rate of improvement versus the overall long-term picture. So consumer items and services, search activity is what we see in your chart. Now, some of that has come down over the last month, but since the worst in the spring, we're up. So it's like the short term, the rate of change, yes, it's in the right direction. But then the broader employment picture is like harder to figure out whether or not we're really gonna improve much.
Yeah, and that's the issue. So you have the equity market has been incredibly correlated to essentially a grouping of these metrics that we're showing here. So what we're doing is we're using search activity to our advantage. These are the intentions of consumers. And if we look across these categories as well as a few more, throwing in what have been really strong, home improvement and also real estate in general, you get this indication that really overall activity is running about where, on median to slightly better than median if you look back to 2018 to essentially the beginning of 2020. And that's kind of where the stock market is. The stock market's rebounded. You've had these going out stocks that, yes, have not kept pace, but you have these staying in equities, technology, and so on that are up 25, 30% now year to date. And they're just hyper focused on this consumer picture. So any indication the consumer is still spending, still going to buy houses and so on, the equity market is going to rally with them for the most part. The bond market is where things get a little bit more interesting, to say the least.
All right, so it's getting a little bit interesting. We've finally gotten a little bit of a sell-off here this morning. The economic data on the employment situation, the job situation, to your point here, Ben, it's improving, but it's not necessarily an obvious catalyst for bonds to suddenly reverse course, right? So is there anything, what's the inflation potential? Do you look at stuff like PPI and CPI in a short term, or are you more focused on the longer term? DGT, I believe, is your acronym that you've talked about with us before, right? Demographics being the first in capital there.
Yes, I think you have to have a medium to long-term focus, especially with inflation. So we had this scenario where we had an incredible pop in flexible CPI in July. We posted about a 1.74% number. That led to CPI having a modest beat at 0.6%. That's all fine and dandy. And yes, that does correlate for the most part with inflation expectations being tips break evens. But the problem is we have two dynamics at play that are making inflation expectations look much more exciting than they really are. One being liquidity premiums have improved substantially, which has also helped real yields drop to a certain extent and also helped inflation expectations, the difference between the nominal yield and the real yield to rebound, meaning tips as an instrument have become more liquid thanks to the Federal Reserve. The other scenario, and maybe perhaps more importantly, is that inflation expectations have put a floor in place. And yes, we've had this floor rise. Now markets are pricing in a better than 70% probability headline CPI can average above 1.5% for the next 5 years. That's great, but the right side tail of inflation expectations has barely budged. They're still pricing in about a 30 to 40% probability that we can even see the Fed's target within the next 5 years. Now, here's the funny thing, and you have this great chart up showing search activity. And this reinforces the point that no one knows or has a clue what inflation is going to do over the next number of years. So here's three competing different types of things that inflation could do. Hyperinflation, which of course, gold bugs and the like will like to discuss and is being fueled by the move. Stagflation, a slow growth environment with higher inflation. Then, of course, you have the opposite side of the coin, disinflation. And all of these searches have all of a sudden risen to some of the highest, really, that we've seen in years, showing that inflation is on the brain due to deficits getting redder and redder. The central bank balance sheets still, extremely large. But the problem is no one knows. And if you look at also a compilation of how do we know where inflation's coming from? All these different fancy economic models people use, from ADAS models all the way out to the wealth effect, they've all rebounded as well, really showing again that the impetus of what's going to drive inflation is an unknown. So it makes me nervous to really chase this inflation story over the short term, given such wonky numbers and this huge print and flexible CPI, and what will likely result in a reduction in inflation thanks to a still broken jobs market by really the tail end of the summer months and beginning of the fall months.
So Ben, this is where we go from the economic expectations to the market implications. And just to iterate your point about the economic and the job situation, you've got a search activity chart also, if we can bring it up, showing that job seeking and recruiting, not good trends here from left to down and to the right. So as we process that information, now let me ask you this, because it kind of reminds me, we were having a conversation almost a year ago now, actually, in a similar vein, where we were going through this period of kind of malaise in a way. There were a lot of calls for the tariff wars to turn into currency wars, World War III stuff, U.S., China. I mean, it's comical in retrospect to some degree. Maybe not, as some of the issues are boiling over again. But the idea is that we heard a lot of folks saying inflation's nowhere to be found. It's not coming anytime soon. The Fed needed to cut its way to keep us afloat. But then all of a sudden, the bond market started selling off pretty hard. It sold off real hard in September. It sold off hard in October again. So even if the economic situation right now is not convincing for inflation, does that mean that bonds are safe where they are? What do you see? Is there potential for volatility even without hyperinflation that gold bugs want?
I think that the quick answer, unfortunately, is no. So we've had such historically low volatility, again, thanks to really this right side tail of inflation not showing up. But if we look and use what we said, DGT, demographics, globalization, technology, and use that 1980 to pre-crisis period to then apply a model using that data to where yield should be, we find that they should be right around 35 basis points, meaning the U.S. 10-year note. That is kind of its break point, or real, not break point, it's a more natural rate. So we wouldn't be surprised to see us slowly gravitate to that point. I think it's going to be hard to get an appreciable rise in yields here going forward. About a year ago when we discussed this, it was a different scenario. We had an incredible fuel of flows into safe assets and into governments. This time around, that's very different. If you look at ETF flows throughout this year, individuals on a rolling 3-month basis stopped sending flows to governments altogether around the middle, or really kind of around the second week of June. And all of that money has been funneled other places, places like gold, which is now taking in almost 15 cents in every dollar that gets invested in ETFs. And then, of course, your corporate bonds and including your aggregate bond indices. So I think that we don't have the same overbought condition within treasuries, and we have this pseudo yield curve control going on. And historically, if you look for breakouts in yield, meaning breaks to lower yields, the only time you get these really quick moves to lower yields or a break to higher yields is you have to have implied volatility running higher than normal, and you have to have positioning offsides in some capacity. That's just not the case in this environment. The
positioning part, I think, is really interesting here, Ben, and I think it's a really good point, because we haven't had that same powerful flow story in the 3 to 6 month range. But what about the very long term? What about where the Fed has only been moving in one direction for the better part of, I mean, it's this cycle, let's just go there for 10 years basically, right? If we actually do have this turning point where things do improve, and the worst, this pandemic is over, this crisis didn't sink us into depression that many were expecting, that we don't get the negative rates. If that trend has stopped, does that have an effect on bonds? Is the evidence from the data that you're pointing out in demographics so compelling that it will keep yields trapped even if the Fed's game of lower and lower is finally done?
Well, yes. I mean, so there's a lot of inertia there. So within that demographics, we can't change that. We'll continue to get older and older till 2031. Now, globalization's a big wrinkle, and we've seen that go in reverse quite quickly. That can have a long-term effect. We don't know how that is going to play out over the next 1 to 2 years. There is facts in the data, in the relationships, in that when globalization does reverse to an appreciable degree, you will see higher headline inflation. So what I think everyone should use as a benchmark is really how are investors pricing in the potential for the Fed's target of 2.0% becoming a reality. And if you get into the options market in inflation, they're called inflation swap caps and floors, and you look at the difference of those premiums, you can determine that probability. And right now, that probability is around 34% for the next 5 years. You get 50+% probability in terms of investors really see a right side tail to inflation. That is when bonds become unattractive and you start to see higher yields and a demand for higher yields. And I think that would be the catalyst. Until that happens, I am not so concerned about a rip-roaring rise in yield on the horizon. So I think that is for sure kind of that line in the sand for me.
Okay, compelling case made. Appreciate you joining us, Ben. Good stuff. Looking forward to more as always.
Thank you.
Thank you. Ben Breitholtz, data scientist at Arbor Data. Really good stuff.